If you're considering buying a home, you've probably heard about different mortgage options, including adjustable rate mortgages, or ARMs. These types of loans can be attractive because they often start with a lower interest rate than fixed rate mortgages. But they come with a level of uncertainty that every home buyer needs to understand. The interest rate on an ARM isn't fixed for the life of the loan. Instead, after an initial period where your rate stays the same, it adjusts periodically, which means your monthly payments can increase. This might not sound so bad if you plan to move or refinance before the rate adjusts, but there are no guarantees that refinancing will be an option. If the value of your home drops, or if you run into financial difficulties like losing a job or facing unexpected medical expenses, you might not qualify for a new loan. That's why it's important to understand how ARMs work, how they affect your monthly payments, and whether they make sense for your situation. An ARM's interest rate is determined by two key components, the index and the margin. The index reflects general trends in interest rates across the economy and can change over time. Different lenders use different indexes, such as the U.S. prime rate or the constant maturity treasury rate. The margin, on the other hand, is a fixed percentage added by the lender. While you don't have control over the index, you can shop around to find a lender offering a lower margin. Your loan estimate, which is a document your lender provides when you apply for a mortgage, will show both the index and the margin that apply to your loan. One of the biggest things to pay attention to with an ARM is how long your initial interest rate will last and how often it can change after that. You might see ARMs labeled as something like a 5-1 ARM or a 5-6 ARM. The first number tells you how many years your initial interest rate will stay the same. The second number tells you how often the rate will adjust after that. For example, a 5-1 ARM will have your rate remain the same for the first 5 years and would then adjust once every year. In contrast, a 5-6 ARM, your rate remains constant for the first 5 years. After that, it adjusts every 6 months. These adjustment periods can vary from loan to loan. Some adjust every year, some even every month. And just because interest rates in the market stay relatively stable doesn't mean your ARM's rate won't change significantly. When the adjustment period begins, your new rate is determined by adding the current index to your loan's margin, which can sometimes result in a much higher monthly payment than you initially expected. When you apply for a mortgage, your lender is required to give you a loan estimate, which is a document that lays out the key terms of the loan being offered. If you're considering an ARM, you'll want to pay close attention to the details in this document, particularly the interest rate section. This section shows your initial interest rate, how often it can change, and the highest possible rate you might pay. Your loan estimate will also break down your initial monthly principal and interest payment. It's also important to remember that with an ARM, this amount only applies during the initial interest rate period. Once your rate starts adjusting, your monthly payment can change. The loan estimate also shows projected payments, including the potential minimum and maximum payments you could face in the future. This section includes not just your principal and interest, but also other housing costs like mortgage insurance, property taxes, and homeowners insurance. These additional costs can fluctuate over time, so it's important to budget accordingly. A lot of people choose an ARM because they believe they can refinance before their payments go up. And while that's possible, it's not necessarily something you should count on. There are a few questions to ask yourself before committing to an ARM. What happens if home values decrease and you owe more than your home is worth? What if an unexpected financial event like job loss or medical bills impact your ability to refinance? These scenarios could make refinancing not an option. And if you aren't able to refinance, can you still afford the maximum interest rate and payment under this loan? When your initial interest rate period ends, your interest rate will adjust based on what's called an adjustable interest rate, or AIR table. This table, which your lender is required to provide, explains how your rate changes over time. It will outline key details, including how your new rate is calculated, what your initial interest rate is, the highest and lowest possible rates over the life of the loan, and how often your rate can change. Your loan servicer will notify you ahead of time when your payment is about to change, so you can plan accordingly. But since there's no way to predict exactly what your rate will be, it's important to consider whether you can handle an increase in your monthly payment. Some lenders offer what's known as a teaser start or discounted rate. This is a lower than normal interest rate designed to make the loan seem more attractive. But once the teaser period ends, the rate jumps to what's called the fully indexed rate, which is the index plus the margin. For example, if a lender's fully indexed rate is 4.5% and they offer you a teaser rate of 3%, your rate will jump up once the introductory period is over, even if interest rates in the market haven't changed. When you apply for an ARM, your lender will give you an ARM program disclosure. This document outlines key details like which index is used, how often your rate and payments adjust, and whether there are any caps on interest rate increases. It also tells you whether the initial interest rate is lower than the fully indexed rate. Since different lenders offer different terms, it's a good idea to compare offers to find the best fit. Be sure to ask your lender plenty of questions, like how rate adjustments are calculated, whether there are limits on how much your rate can adjust at each adjustment, and what type of information you'll receive when changes occur. Some ARMs include a conversion option, which allows you to switch to a fixed rate loan later on. While this might sound like a good feature, keep in mind that the new fixed rate is determined by a formula in your loan documents, and it may be higher or lower than current market rates. Some lenders also charge a conversion fee. Certain ARM features can lower your payments in the short term, but come with some risks. For example, some lenders let you pay points at closing to get a lower interest rate. However, with an ARM, this lower rate usually only lasts during the initial rate period, meaning you could end up paying more in the long run. Make sure to check your loan estimate carefully to see if points are included in your loan terms. ARMs can be a useful tool for some homebuyers, but they aren't right for everyone. Before choosing an ARM, make sure you understand how rate adjustments work, how your payments could change over time, and whether you're comfortable with the risks involved. Carefully review your loan estimate and your lender's ARM disclosure, and be sure to ask plenty of questions so you can make the most informed decision for your financial future. The more you know, the better your decisions will be. Navigating mortgage options can feel like a lot, but you don't have to do it alone. A knowledgeable mortgage loan originator can help walk you through your options to secure the best loan for your needs. You can connect with a lender today who approaches their work the same way we do, putting you in control by getting you the necessary information to make the best decision for yourself. The link to schedule a call is provided below.